So, okay, we will start in next 2 minutes. Can somebody write in a chat box how many are from a Chennai? Because the mode of session will be totally in English today. And for initial 1 hour, it is only and only for a new user. I'm again repeating, initially for a 1 hour, it is only for a new user. So how many are from a Chennai? So today mode of session will be only in English. Okay, perfect. Am I sufficiently audible to each and everyone? When one can write in the chat box. So the user who already know the broader navigation and have a overview of a platform, they can just leave it and they can join us back at a 1 p.m. For initial 1 hour, it is actually for a new user. So once you have onboarded with us, you will get a mail from a Bulyankar Gurukul, and that mail will come into your registered mail ID. Once you will search in the name of Mulyankan Gurukul in your registered mail ID, you will get a folder from a Mulyankan Gurukul. This is a one-stop cloud link. So this is the one-stop cloud link where all the future updation will take in a same place. Means I will not share the mail each and every month. Please bookmark my this particular mail. Every future updation will take place in the same mail. So kindly bookmark my mail, which is in the name of Mulyankan Gurukul in your registered mail ID. So once you click on a folder or once you click on an open button, either on a folder, either on an open button, it will take you towards our cloud window. And that cloud window will look something like this. So the objective of today's session is to cover the valuation cycle workbook, business cycle workbook, category selection, and algo master summary. So we will be covering the 4 workbook. We'll have an overview and a broader navigation of a valuation, business, and a category selection. And then we'll look into the algo master summary, which is nothing but the summary of all these 3 workbooks. So what does this platform actually do? So we provide a data science based framework and a system which evaluate valuation cycle and earning cycle. And on the basis of this assessment, it helps you in a capital allocation with respect to the core portfolio, with respect to the satellite portfolio, and with respect to the style selection. So again, I am repeating, it looks after a valuation and a earning cycle from the lens of a data science and help us to assess where are we standing in the cycle. And on the basis of that cycle, it helps a user to select the asset class, category, subcategory, sectoral, global market, and last but not the least, style. So what we strongly believe, the advisor alpha will be created moreover from a asset class selection, category selection, and a subcategory selection. Fund selection do play a role, but it is actually the last part of a advisor profile, not a front profile of an advisor. So suppose if I'm bringing a 10 lakh rupees to you from an investor perspective, suppose if I am an investor and bringing a 10 lakh rupees to you from an investor perspective, I will always seek a best fund from my advisor. I will always seek a best from my advisor. But you as an advisor understand that it is not about the best fund selection. It is first about whether Ashish money should go into the lump sum mode or STP mode. If it has to go into the STP mode, then when that STP should be get closed. If it has to be go into the lump sum mode, then how much into equity? If X amount is going into equity, then what are the categories which are favorable? What are the categories which one should avoid at this particular juncture? And thirdly, what are the subcategories which you should do? And what are the subcategories which are like unfavorable and which one should avoid? So it is basically tells you at what environment, at what cycle, at what zone, what are the categories that are favorable and what are the categories that are unfavorable. So it is not about the best fund selection. It is all about at what time, what category you are putting in the money and with what mode you are bringing that money. So whether you are bringing that money through a lump sum mode or a STP mode, and at what environment, at what cycle, which category you are putting in the money. So most of the advisor alpha will be created from asset class and a category selection rather than a fund selection. So let me just give you an example. Suppose if you have chosen the best of the best corporate bond fund, but if in an interest rate environment, if in a particular interest rate environment, if a corporate bond is not going to work, then does the best of the best corporate bond fund will work? No. So in order to get the corporate bond fund get work, a corporate bond category need to work. So that is how it is. So our focus is totally on a top-down approach. And from a similar perspective, we will look into each and everything that how through a structured framework and system, this basic advisor capital allocation could be addressed. So we look at the same fundamental data, but our lens is totally different. We look from the lens of a data science. So till date, there were two fields in our industry. That was a fundamental and second was a technical. The third emerging field is a data science field. So basically, if in a short, if I explain you what we are exactly talking about and what does this platform exactly do. So as an advisor, your key role is to do a risk profiling of an investor. And as a platform provider, as a Mulyankan Gurukul, our forte area is to do a risk profiling of an asset class and a category. I'm again repeating, as an advisor, your primary role is to do a risk profiling of an investor where you set the goal for an investor, where you set the time horizon for the investor, where you evaluate the risk appetite of the investor. So this is all the work which is being done by the advisor. Our primary area or our forte area is with respect to the risk profiling of a asset class and category. So what we strongly believe, if an advisor do a risk profile of an investor very appropriately, and if there is a structured framework and a robust system which you do a risk profiling of an asset class and category, and if we integrate the both of the solution of a risk profiling of asset class and risk profiling of an investor, then our decision making could be more prudent. So first of all, whatever we will learn independently through a risk profiling of an asset class. Then we will integrate the risk profiling of an investor with a category and an asset class. So at a first step, first of all, let's learn how to do a risk profiling of an asset class and a category. So we look at the same fundamental data, but our lens is different. That is what I have told you. Now just let me take you towards the traditional band philosophy which is being used in the industry, and the way environment is changing, this band philosophy is not going to work. I'm again repeating. From the AMC, we have learned that there are various band for a various valuation metric. Let's say for a price to earning, there is a variation, there is a various band, and for a price to book, there is a various band. Different manufacturer uses different valuation metric, but the core foundational philosophy is same, that they use a band philosophy. That at this particular band, they will keep this particular equity. At this particular band, they will keep this particular equity. So just let you explain you this in a very simple example. So all these band are being made on the basis of past data. What they have done from where generally market has fallen, they have made a higher band, and generally from where the market has recovered, they have made a lower band. So from band, they usually tell that at 15p they will keep this particular kind of equity allocation. At 5 to price to book value, they will keep this this particular equity allocation. But all this band theory, whether it is respect to the price to earning, whether it is respect to the price to book value, whether it is respect to the market cap to GDP, or let's say yield gap, bond equity earning ratio, dividend yield, whatever metrics they use a band philosophy. So first of all, we are challenging the way environment is changing. This band philosophy is not going to work. So if this band philosophy is not going to work, then what is the alternate solution for that particular thing? So we look at the same fundamental data. So let me just take you towards the broader navigation with respect to the first worksheet. That is a valuation cycle worksheet. That if this band philosophy is not working, then what is the alternate solution? So how we study the same valuation cycle, but our lens is different. So I will try to make you understand in the language which you understand. So if I open a valuation cycle workbook, that valuation cycle workbook will look something like this. So we have 6 Excel-based dashboard like this. So we have 6 Excel-based dashboard like this. One at dashboard learns about a valuation cycle, evaluate valuation cycle. The second dashboard evaluate the earning cycle. Third dashboard evaluate the category selection. Fourth dashboard evaluate the sectoral and global market. Our fifth dashboard evaluate the style selection. And the last, the algo master summary is actually the master summary of the whole of the core allocation. So my each and every dashboard will be divided into 3 colors. That there is a blue color, orange color, and a green color. So in green color, you will have all the underlying rationale. In orange color, you will have all the detailed working. For the set of advisors who are not interested in going into the detail for each and every metric and their score, they can directly refer the summary section. So I have provided according to the user. If a user have a time, energy, and they can, if they want an in-depth exploration with respect to the platform, or let's say a framework, so there's nothing like a black box. I'm very transparently showing you that whatever guidance you are getting in a summary, that guidance is backed by a detailed working, and behind that detailed working there is a whole lot of a underlying rationale. So whenever you put a cursor on any particular verb on any particular tab, a description box will get opened. This will tell you what is the content and how to read that particular content. So I'm not going through each and every tab. You can go and you can make your, if you want to develop your own system on the basis of our algorithm, you have the flexibility to do that. So that's why, because why, and now you will ask me, Ashish, why so much worksheet and why so many Excel dashboard? Because we have made this platform from a fund manager perspective also. Some of the fund manager using this as a supplementary tool for a second opinion. So if a user have a, let's say, time, energy, and they want an in-depth exploration, they can go for each and every worksheet, and they just put a cursor on particular worksheet. A description box will open, and this will tell you how to read that particular chapter. Once you will click on that particular chapter, you will enter into that dashboard. Sorry, you will enter into that particular worksheet. So I will be just covering the first initial P and price to book value with you, because our industry or our fraternity is well versed with the price to earning and price to book value. So let me just cover the price to earning and price to book value. This is like the basic metric which is being used by manufacturer also, and this is like the foundational metric which is very much well understood by our fraternity also. So let me just start with the price to earning and a price to book value. So we look at the same data, but our lens will be different. So I will try to make you understand in the language which you understand. So in industry, what we have learned, that all these valuation metrics are a finished product and all the assessment should be done on the basis of this valuation metric. But in data science, we took this valuation metric as the input. If you see this input in our data science, all this valuation time tested metric which is being used by manufacturer, in data science we take this as an input. After taking this as an input, various scores are being calculated through a various statistical analysis, and after that, on the basis of that score and on the basis of the range of the score, the final action point or the final inference is being taken out. So let me take you with the input and how to calculate the score and how to take out the inference, or let's say how to understand the significance of any particular score. So let me try to make you understand in the language which you understand. So this is the only particular worksheet. Even if you understand this particular worksheet in a valuation cycle, your decision making with respect to the valuation study could be 90% improved. I'm again repeating, even if you study this particular worksheet, your decision making could be 90% improved by just studying price earning and price to book value. But internally, we use 20 plus matrix and we calculate n number score of this 20 plus matrix. So our entire framework system is built on a 50 plus score. But I will make you explain the score in the language which you understand in a very simple language. Let's go through this particular price to earning and price to book value score. So we are looking at the same data. Now let's say we should, now in data science, we don't consider about the market level. We are least concerned about the market level. We don't look at the valuation data also. We look at the valuation score of the valuation data. So how these score are being calculated? Now in very simple and easy to understand language. Sorry. No, sir, you have to download this file on a fortnightly basis. So is this screen visible to each and everyone? So let's understand the basic concept. So let's understand this concept when I'm saying about a, just a minute. Hello. Meeting now. So when I was saying risk profiling of asset class category, so if I took the very standard measure of a risk, the very standard measure of the risk in the industry is the standard deviation. Now, let's keep aside the very technical definition of a standard deviation and the technical formula of a standard deviation. Let's see how this standard deviation could be applied in a real life scenario. How this standard deviation could be applied in a real life scenario. So let's say 5 foot 7 inch is the average. 5 foot 7 inch is the average height of a 18-year population in India. 5 foot 7 inch is the average height of a 18-year male population in India. And 0.3 is the standard deviation. And 0.3 is the standard deviation. 5 foot 7 inch is the average height and 0.3 is the standard deviation. Now, if I want to arrive at a standard deviation 1, what I will do, I will add the mean height and a standard deviation. I will add the mean height and the standard deviation. So if I add 0.3 into 5.7, or let's say 5 foot 7 inches is the average height of an Indian male population, and if I add 0.3 into it, that take me towards a 5 foot 10 inch. That take me towards a 5 foot 10 inch. So let's say let's say if you randomly pick 100 people from India. So if you randomly pick 100 people from India, 68% of the population will fall below 5'10" or within 5'10". So 68% of the population will fall within 5'10". Now where does this 68% coming from? This 68% is the theorem of a standard deviation 1. This 68% is the theorem of a standard deviation 1. We are not going into that how this 68% is being calculated. We are actually applying the standard deviation theorem 1 into this particular example. So 68%, if you will Google it, you will get the standard deviation theorem 1 as a 68%. That means in standard deviation 1, the probability of getting male population above 5'10" is only 32%. If you randomly pick 100 people from India, 68% will fall below 5'10". There is the probability that 32% will fall out of 5'10". That is the theorem of a standard deviation 1. So in standard deviation 1, you have a 32% probability to get out of a one theorem. So if I again add 0.3 in 5'10", I get 6'1". I get 6'1". So standard deviation 2 theorem tells you. So standard deviation 2 theorem tells you. So if you randomly pick 100 people from India, 100 male population from India who are like 18-year age, 95% will fall within 6'1". 95% will fall within 6'1". So what is the probability of getting the height which is more than 6'1"? What is the probability of getting the height which is more than 6'1"? Is the 5%. So in standard deviation 1, 68% gone, 32% left. Standard deviation 2, 95% gone, only 5% left. So this is the theorem 32 and 5 is the theorem which is already being calculated in the industry through various formula and it is already available in the Google. Now what we are trying to do here is we will try to calculate the same for a price to earning and a price to book value. That is the mean height, the standard deviation and the standard deviation 1 and the standard deviation 2. You are getting my point? Any doubt till here? Any doubt till here? You can pause me and you can ask me because if you are not clear with respect to this, it will be very difficult to understand going forward. So what I will do, I will calculate the mean height of a P and a mean height of a price to book value, and then I will calculate the standard deviation. And then after calculating the standard deviation, I will calculate the standard deviation 1 and I will calculate the standard deviation 2. So similarly, the way government has done for a population which is being implemented through height, let's say we are implementing the same here. So after taking a data from a 1996 to 2004, after taking a data from a 1996 to 2004, now let's forget that you are sitting in 2024. Now let's forget that you are sitting in 2024. Now let's totally focus that what is happening on a 1st January 2004. What is happening on a 1st January 2004. So first of all, we have calculated the mean data from a 1996 to 2004. If we are sitting in 2024, then we will calculate the mean data from 1996 to 2023 December. So that is how it is. If you are getting more and more data, this system will become more and more robust. So you will ask me, Ashish, why only 2004? Why not 2003 or why not 2005? Because from 1996 to first 2004 data, we have got enough sample with respect to, let's say I have got the height of a 6'4" also, I have got the height of a 5 foot also. So what I'm trying to say is I have got enough data variation from a 1996 to 2004. But this data will keep increasing the way date will get increasing. So in 2025, I will study the data from 1986 to 2024. In 2030, I will study the data from 1996 to 2029. So let's dramatize the situation that we are sitting in 2004 rather than 2024. Now 15 is the mean height of the P. So first of all, what I have told you, that band philosophy is not going to work. So we'll not look at the static band that is made from the industry. I am again repeating, if the market levels are dynamic, the valuation study can never ever be static. It has also to be very dynamic. If a market level are dynamic, the valuation study can never be static. It has also to be very dynamic. So rather than relying on a band, we are calculating the mean of a P first. So the mean is coming 15 here, and the 4 is the standard deviation which is coming here. 15 is the mean of the P, and 4 is the standard deviation of the P. Now, if I want to arrive at standard deviation 1, if I want to arrive at a 1 score, how will arrive? How will I arrive at a 1 score? I will add 15 and a 4. I will add 15 and a 4. That is, I will get 19. So at so 19 is the standard deviation 1 here. So suppose on 1st January 2004, if you are getting a 19p, on 1st January 2004, if you are getting a 19p, the margin of safety which is already gone from the market, the margin of safety which is already gone from the market is 68%. So what is the margin of safety which is left for equity market? Or let's say, what is the risk reward favorable towards the equity market? How much is the risk reward favorable towards the equity market? Only 32%. So if you are getting 19p on this particular date, only 32% is the risk reward favorable, which is actually left in the market. Now, in order to arrive at standard deviation 2, I will add 19 and a 4. So first I will add 15 and a 4. I've got 19p. Now we'll add 19 and a 4. I've got 23p. So standard deviation 2, if 23p is coming on this particular date, if 23p is coming on this particular date, the margin of safety which is available in the equity market is only 5%. The margin of safety available in the market is only 5%. So let me take you back from where I have started. So let me take you back from where I have started, that it is not about a fund selection at first. It is about at what time you are doing a lump sum and on what time you are doing as STP. The first advisor alpha will be created from when are you going into the lump sum and when are you going into the STP. Suppose if a market is conducive for a lump sum and you are doing the STP, the whole lot of advisor alpha will be vanished. So first of all, for the first decision the advisor take is the, if I am bringing the lump sum money, it should go into the lump sum mode or whether it should go into the STP mode. Now let me tell you one thing, 80% of the STP which is being done in the industry on the basis of gut, on the basis of experience, on the basis of knowledge doesn't work. So in data science, each and every answer is very structured and very specific. There is no blurred area. So whatever answer we will see here, it will be very structured and will be very specific. It will not be on the basis of gut. It will not be on the basis of event or news. It will not be on the basis of experience or knowledge. It will be totally and totally backed by data. So any doubt till here, sir? Any doubt till here? Any doubt till here? You can write in the chat box. Or you can unmute yourself. So first of all, we will evaluate whether our money should go into lump sum mode or STP mode. So let me give you one example here. Now 19 is the standard deviation 1 and 23 is the standard deviation 2 here on 1st January 2004. But the actual P on this particular date is 21. But the actual P on this particular date is 21. Now 21 falls between 19 and 23. That means 32% of the, that means 68% is already gone from the market. 68% means 68% of the margin of safety is already gone from the market. Only 32% is left. Now it is between 19 and 23. The 21p on a 1st January 2004 is between 19 and 23. So the exact score which is coming is 1.38. So the exact score which is coming is a 1.38. So if you are closer to 0, the probability of making money is totally in your side. I am again repeating, if you are closer to 0, the probability of making money is totally in your side. If you are closer to 1, that means only 32% margin of safety is available in market. If you are closer to 2, that means only 5% margin of safety is available in the market. Now the score is 1.38. That means already 32%, already 68% is gone, and 32% is also not there. It is somewhere around 20% margin of safety is available. So I'm again repeating, at 0, the margin of safety is totally in your favor. In 1, it is 32%, 2, it is 5%. Now the score is coming for, let's say, for a price to earning, the score is coming 1.38. Now, if I am giving you 10 lakh rupees here, now if I am giving you 10 lakh rupees here, irrespective of my risk profile, let's keep aside my financial goal, or let's keep aside my time horizon. By just evaluating the risk profiling of an asset class, can you suggest me whether I should go for a lump sum or whether I should go for STP? Can you suggest me? You can unmute yourself. Should I go for a lump sum or should I go for STP here? Perfect, sir. Muruganathan sir has told STP. I want the answer from other. Perfect, sir. Perfect. So similarly, what we will do, we will calculate the 012. We will calculate the 012 for both price to earning and price to book value, because we have considered P and PBV here. And now whatever assessment we will do, or let's say whatever inference we will take totally on the basis of 012. Now we will not take into the consideration the market level. We will not look at the valuation matrix. We will just look at the 012. In 0, the margin of safety is totally in our favor. In 1, only 32% is margin of safety is in our favor. In 2, only 5% margin of safety is in our favor. So rather than going into the daily mode, let's transform this into the monthly mode. Let's transform this into the monthly mode. Now the score for a P is 1.36, and now the score for a price to book value is 1.45. The score for a P is 1.36, and the score for price to book value is 1.45. What we will do here? Now suppose if I am bringing you the money, what we will do here? Sure, sir, sure. Now let's say if both the score are near to 0, you should sell everything. If you are getting a loan, take a loan and buy equity. If both the score are near 0. If any one of the score is near 0, you can overweight into equity. If both the score near 1.25, one should be cautious and should go for a STP mode. If both the score are near 1.5, or let's say above 1.5, if both the score are near 1.5 or above 1.5, one should go into the debt. It is very simple. So the first advisor alpha will be created, whether you should go for a lump sum, whether you should go for a STP, at what time that STP should be closed and should be converted into equity, at what time the equity should be converted into the debt. If your decision making with respect to these 3 decisions are well sorted and are very structured and framework driven, rather than on the basis of your gut, rather than on the basis of what your fund manager or what your area manager is telling, or whatever your media or your magazine is telling, irrespective of media, magazine, manufacturer, if you make these 3 particular decisions, when to go for a overweight, when to go for a STP, when to stop the STP and convert into equity, when to convert the equity into debt. If this decision are sorted, 80% of the advisor alpha will be created from this only. 80% of the advisor alpha will be created from this only. Now the score price to earning is 1.36 and for the price to book value it is 1.45. Now I'm again asking you the same question. If I am bringing a 10 lakh rupees to you, whether I should go for a lump sum or whether I should go for a STP. I will go for a lump sum or I will go for a STP, sir. Ajay sir, Ambar Modi sir, Amol sir, Anil Kaka sir. Naveen sir, Nitin sir. You can write in the chat box. STP, right? Why will go for STP here? Why will go for STP here? Because at 1, 68% margin of safety is already gone. Now the score is 1.36, 1.45. Only 20% margin of safety is there in the market. And when I'm saying 20% margin of safety, I'm not trying to mean 20% rally. It is a 20% probability I'm talking about. In terms of probability, I'm talking about. 20% is not the rally left. 20% is the margin of safety that is being left in the market. Now the question comes whether lump sum or STP. So we'll go for STP, right? Now the second question comes, when to stop that particular STP? When you stop that particular STP? Now the STP which is being done on the basis of gut and knowledge, that someone go for a 6 months, some go for a 9 months, some go for 18 months. Now let me give you a very eye-opening fact with respect to this. 80% of the STP doesn't work, which is being done on the basis of gut experience and knowledge. 80% of the STP doesn't work, which is being done on the basis of gut or let's say on the basis of narrative. What I'm trying to say is 80% of the in 80% of the STP, the NAV which you get as an average NAV, the NAV which you get as an average NAV, 80% of the time it is higher than today's NAV. 80% of the time it is higher than today's NAV. So in data science, as I already told you, each and every decision will be very structured. Each and every decision will be very specific. Now, if it is telling you to go for a STP here because of the score, because margin of safety is very negligible in the market. Now, when you stop this particular STP, now the zero is here. You are seeing the zero here, minus 0.22 is what? Zero, right? Minus 0.22 is what? 0. Now we'll close the STP here and we'll convert the whole amount into equity. Why? Because in 0, margin of safety is totally in favor of what? Is totally in favor of equity market. Is this clear to each and everyone? Is this clear to each and everyone? Now, whatever assessment we are doing on the basis of 0, 1 and 2 only. Let's forget 0.5 or let's say 0.7. We'll do on the basis 0, 1 and 2. Machine is being trained to give you the answer for a 0.6 also, 0.7 also. But let us say on the basis of 0, 1, 2. Now we'll convert the whole amount into equity here, right? Now you are least bothered about why the market has fallen from a 1800 to 1400. You are least bothered. If a market has fallen 25% in 3 months, there must be some news or event which has happened in these 3 months. That's why market has fallen from 1800 to 1400, right? Right or wrong? But we are least bothered about what is the news, what is the event that is going on. We are just looking at the score, and on the basis of that score, we are taking a decision whether we should go for a lump sum, whether we should overweight into equity, whether we should go for STP, and when to close that STP and convert into equity, when to convert the equity into debt. As simple as that. Now, whatever we are assessing here, it is totally on the basis of risk profiling of an asset class. I'm not taking into consideration the risk profiling of an investor here. Now, you are just doing the assessment only and only basis of a risk profiling of an asset class. Afterward, once you learn this, then we will integrate the risk profiling of an investor with the risk profiling of asset class, and then we will have a combined answer which takes into the view of the risk profiling of asset class plus risk profiling of an investor. So what I'm trying to say you is, if both the risk profiling can be done appropriately through some framework, through some structured system, our decision making could be drastically improved. Our decision making could be more prudent. Now, suppose if you have missed the rally here because let's say if any particular investor is very keenly watching the news or event and he's not investing in 1500 market, and after 1 year, if a market goes to 2600, will he able to invest that particular money if he's not investing in 1500 market or 1400 market, because he has become a chicken hearted after following the news and event? Will he able to invest after 1 year in a 2600 market? No, right? But if the score is 0, shall I go for a lump sum or shall I go for a STP? So irrespective of market level, your decision should be totally on the basis of framework and system. At 1800 market level, it was telling you to go for a STP. At 2600 market level, it is telling you to go for a lump sum. So that is the beauty. So it doesn't mean that if you have missed the rally from a 1400 market, you can't invest in a 2600 market. If in 2600 market 0 is coming, that means the margin of safety is equally favorable when the margin of safety was at a 1400. So all the level are different, but the margin of safety is totally equal. Now I'll do a lump sum or STP here. We'll do what we'll do? You can unmute yourself, sir. You can, if you want, you can unmute yourself. Otherwise, it could be very one-sided. Now, what you will do? You will invest here also in the form of lump sum only.
So you are only seeing the P, not the price to book value.
So, sir, if both are equal near to 0, then you should sell everything and take a loan and buy equity. If any one of if any one of is close to 0, then you can overweight into equity. If both are above 1, then only you will get cautious. If both are near to 1.5, then you will come out
But
of the
if the
equity
case
market
is
and
reverse, one is nearby 1.5 and one is nearby 0,
then you should overweight into equity.
Okay.
If anyone is near to 0, you should overweight into equity. Now here, both the score are above 1.25. If both the score are near to 1.25, now why I'm taking you towards this particular level, market level? Because this is the market level, this is the time period where the industry has got the highest inflow in the market. So when I'm talking about the highest inflow, I'm talking about the highest inflow percentage wise of that particular market. Or in that particular market, if you look after, it was getting a highest inflow percentage in equity. So now why I'm taking into this particular zone, because I want to make you prove this particular point is also that this is not a market timing tool. This is a tool which will tell you whether lump sum is favorable or STP is favorable, whether equity is favorable or debt is favorable, whether large cap, mid cap, small cap is favorable, or let's say multi cap, flexi cap, balanced advantage fund, these are favorable. So we'll go step by step in from a top down perspective. So in 4500 market level, now again it is telling you to go for STP.
So you mean to say that technically whenever it crosses 2+ levels?
So sir, whenever it crosses, if both the score are near to 1.25, then you should go for a STP, or you should be cautious with respect to the equity market. If both the score are near to 1.5, then you should actually go into the debt market. Then you should convert your equity holding into debt holding.
Correct. In November 2007 and December 2007, it crosses 2.31 levels, right?
Both, yes. If both are above 1.5, now this is the time. So let's say again you will start a STP here. Okay? Again you start a STP here. But again, you stop STP here because both are about to. But now, after
Okay.
stopping STP, you will not enter into the equity market. Actually, you will book the profit from an equity market and you will enter into the debt market.
Okay. Can you please just move back to the current scenario?
Yes, yes, I will take you towards the current scenario also. Definitely, sir.
Okay.
Just give me a minute.
You are interpreting only on the P part only, is that right? Or you
On,
also
on
consider
both,
the
on the basis of both P and PBV, both.
Okay. See, if P is at 1.31 and PB is 1.74, what is the logic behind this?
So both are above 1.25. That means you should be cautious in the market. If both are
Okay,
above
okay.
1.5,
So,
that means this is a time that you should book profit from a equity and you should go into the debt.
okay. Can you please write down this logic on the separate sheet?
Yes, yes, there is
Whenever.
already said this logic is already being written in our express group.
Okay, okay,
It is
okay,
already
fine.
being written in your express group. Yes.
And do we need to verify this data sheet on a monthly basis or weekly basis, or
So,
how
sir,
it
we are
works?
sharing this on a daily basis with our
Yeah,
users.
yeah, I agree. You are sharing it on a daily basis, but the fluctuation will be on the monthly basis
Yes, so
only,
it
no,
may
right?
happen that fluctuation may happen in a monthly basis, or it may happen the fluctuation may happen after 18 months also. So
Yeah,
you
reason,
never ever
like a
know.
quarterly
But
once, yes, correct. Quarterly once companies are announcing the results, right? So based on that, only P and PB will fluctuate, right?
right, sir, right. Now again, you will do the STP here. Now the next question comes when to stop the STP. Now both the score are 1.5 here. Now again, you will stop the STP, but rather than converting that STP into the equity, you will
Okay,
convert that particular thing into the debt. Now for the set of
okay.
advisor, now
And
our this particular algorithm is being trained for both the set of advisor who
okay,
want to enter into favorable zone and who want to exit in unfavorable zone. For those set of advisor, this already algorithm is already in place. Now our machine is being trained for those set of advisor also who says that Ashish, our investor time period is long term, then why to go into the debt market? Second, Ashish, I don't want to go into the debt fund because there will be a capital gain issue. So for those set of advisor who will do the STP here, they will not convert into the debt, but they will wait for the zero again. Once the zero will come here, they will convert the whole equity, they will convert the whole STP into the equity. But for the set of advisor who have converted their equity holding into debt, they will again convert their debt into the equity here. Now here both the score is zero.
okay.
You will do the
And
lump sum of
is this
STP here. You will do
and
the
and is
lump
this
sum.
only
I
for
will sell everything and buy equity because both are zero.
and is this only for large cap or mid cap or small cap?
And then the third question is that we will come into, sir. First of all,
Okay,
let's
okay.
decide whether we should go for lump sum or STP,
Yeah, yeah.
whether we should overweight into equity or underweight into equity. Then we will decide which category to overweight and which category to underweight. Yeah, man.
And
So we will come step by step, sir. Please ask question which we have already covered. We'll come step by step.
have you done back testing for the this model, sir? How much aggregate returns you have generated on this based on the data sheet?
So, sir, the back testing which has been done in the industry is totally on the basis of curve optimization. Actually, doesn't work. What I'm trying to prove here is that I'm trying to prove the standard deviation theorem whether it works or not. The standard deviation theorem on extreme zone, let's say if it is zero and you are exactly doing opposite to it, you have a 0.1% probability to get right. I'm talking about a 99.9%. And suppose if a score is near to 1.5 and you are selling the mid cap fund at that particular time, you have 99.9% probability to get wrong.
Yeah, I agree. How much aggregate income? Say, for example, if any normal SIP
So
investor is
that
make.
we will come into, sir. We will come into, sir.
Okay,
So
okay,
any
thank you.
question which has already been covered, and if you are not understanding that, I will cover first because whatever you are asking, I will cover that step by step in a very structured manner.
Okay, thank
So
you, thank you.
if you randomly jump into the question that which category, which sector, then it will then the whole participant will get confused. Let's focus one by one. So first of all, so the next question is, what is the probability of getting money at zero? So someone is exactly doing opposite. Let's say if it is telling you to go for a lump sum at zero and you're going for a STP mode, your probability of getting wrong is 99.9% over the period of time. If it is telling you 1.5, You should be cautious in equity. You should have a cautious equity category. And if you're going into the aggressive equity category at that particular time, again you have a 99.9% probability to get wrong. So this theory actually works very well, and we have not seen only in this particular Indian market. What we have seen, we have calculated the same for a US market as well from a 1907 to till date, and you will be surprised to know this. None of the Six Sigma event has never ever happened at zero. All the Six Sigma event, or let's say all the event because of which, let's say, the market fall, or let's say because of which the market goes into the bear market. The bear market definition is the market which falls from greater than 18%. All the event which has happened, and on the basis of that, the market has fallen more than 18%. It has never ever happened in zero. It has always happened in greater than one. So whoever do the event also, whoever trigger the event also, they also believe in the numerology. That is what we believe. So all this, even if these all are conspiracy theories, all these conspiracy theory do follow the numerology. So at zero, the probability of making money is totally in your favor. Above one, the probability of making money in US, it is not in your favor. The margin of safety is not in your favor. That is what we can totally infer with respect to the probability of making money from this particular data. Am I clear this to each and everyone? Now let me navigate you through some of the important point here. So why we are least bothered about news or event? Why we are least bothered about what is a war which is going on? Who is sitting at a throne? Who is ruling the country? We are least bothered about that. Law, let's say in August 2013, now I'm not politically inclined to any particular party. I'm just trying to tell you that in August 2013, the Modi ji name was not even nominated. The Modi ji name was not even nominated, and now it is telling you the both are zero. It is telling you to go into overweight into equity from 5,600 level, but at 5,400 level, both are zero. That means you should sell everything and buy the equity into the lump sum board. Now everyone talks about this is a Modi rally, which was from a 2014, but from 2013 August itself, it was telling you to sell everything and go into the equity market. Now, if I talk about the traditional valuation index, which is being followed in the industry, so first of all, we have challenged those traditional valuation index doesn't work, because all of these traditional valuation index are made on the basis of band theory, and that band doesn't work actually. The very real life example is 2020. After 2020, if you'll see, none of the valuation index apart from 2020 March has showed the green, has been into the green. But if I take you towards this only 0, 1, 2, you will have at least have 5 to 6 times zero after 2020 March also. After 2020 March also, you, even if you have missed the rally of, let's say, from a 25,000 to 40,000 of a COVID rally which you have missed, even if you have missed that particular rally, many times it has shown you zero. So if you look after here, now both the score are above 1.25 here. Both the score are near to 1.25 here. Sorry. Both the score are near to 1.25 here. So at 15,000 level, again you will start the STP. At 15,000 level, again you will start the STP. You will put the lump sum till here. Till here it is telling you to put the lump sum. Now from here again it is telling you to start the STP. Now the next question comes, when to stop that particular STP. Now you stop that particular STP here at here. So at
See, one
15,000
question
level, you have
here.
started the STP. At 16,000 level, it is telling you to stop the STP.
See, I have one question.
Yeah, sir.
2021, if you can slightly go up,
Yeah.
on your P, it shows, the numbers are more than 3.
Right, sir.
So you
So
said,
that's why, sir, we are not relying on a single indicator, because relying
no,
on a
let me
single
complete my
indicator.
question.
Huh.
So if you look at for the continuous 6 to 8 months, the number is running more than 2.
Right.
But on the other side, the numbers are like 0.3, 0.4, 0.5.
Yes. So if
But if
anyone
you
is
look at,
near to zero, you will overweight into equity.
correct. So, but if you look at, let's say, you look at December 2020, the Nifty is about 13,900 levels. If you think that the market's probably, for this number to come down, let's say, in Feb 2021, the P level shows 4.08 and the PB is 0.9 or close to 1. But even from there, it has been only rallying. So at that point of time, if we were to take a
that is
decision,
what I've told you, sir. That is what I've told you. Let me highlight you again this particular point. So in 4,500 Nifty level also, the Nifty has rallied from 4,500 to 6,000, right? So what I'm trying to tell you is you don't have to rely on single indicator. Now, when both are above one, let's say when both are above one, from there you start the STP. Now, what has happened here? Why this artificially it has gone to 4? Now, this is like a very, very rare event where the whole world has been locked down, and on the basis of that lockdown, EPS is not coming off the market. When the EPS is not coming, artificially the P has shooten up, and artificially because the P has shooten up, the score of a P is coming 4. So that's why any particular MC which is relying on a single indicator, please leave that particular MC, because by relying on a single indicator, it does not give you a complete picture. So when both are above 1, let's say here both are above 1. So from here onwards, you will start the STP. From here onward, you will start the STP. So of course, from a 14,000 level, 17,000 level, you have missed the rally. So it is not a market timing tool that exact at the top you will start the STP and exact the bottom will stop the STP. It will tell you the zone. It will not help you to time the market. So it is not a market timing tool which I have told you earlier. So it will tell you when to start the STP. Now again, it is telling you to start the STP. Now the beauty is at a 16,000 level, it is telling you to stop the STP. So what I am trying to say is at 115,000 level, the margin of safety was not favorable, but at 116,000 level, the margin of safety is extremely favorable. So we don't have to look at the market level in order to make our decision. It should be irrespective of market level. It should be irrespective of narrative and event. Now, here again, you are getting 0. And suppose if you miss the rally here. Suppose if you
हो
miss
ते
the rally here,
100% खरं आहे पण त्यांना पाहिजे म्हणजे वाटत आहे ना
you are again getting a 0 here. 0.08. So that doesn't mean that 17,000 market, if it is higher than 15,000 market, that means it is expensive. If you are getting 0 here, that means again, even if you have missed the 14,000 Nifty rally, you should again overweight into 17,000. So no decision should be on the basis of a market level. Am I clear, sir? Am I clear? I hope I am able to make you understand this. So that's why I'm not looking at the single indicator. I'm just trying to make you explain with the help of 2 indicators. But in a aggregated manner, we look at the 20 indicator, that to 3 score of indicator. That means we look at the 50 plus score. I'm just trying to make you to take the influence just from a single score. We look at the 50 plus score on aggregated basis.
okay.
But even if you look at this score, your decision making could be drastically improved. Why I'm telling you so? Because most of the AMC has gone underweight from October 2020, if you remember. But still, it is telling you to go overweight into equity till this level, till June 2021. You're getting my point.
Yes.
So from here, you'll go for a staggered investment. And again, 0. From here, the whole money should be converted into equity. Even if you have missed this opportunity to convert into equity, again, you are getting a 0 here. So if you look after the valuation index of the various manufacturers, none of the valuation index, apart from 2020 March, has told you in a green. But there are like several instances where you are getting 0. Now let's see the next 0. The next 0 is coming at 21,000 level. All-time market high, you are getting 0. You will go for a lump sum or you will go for STP here. We should go for a lump sum. Now for the set of user who already know and who already onboarded with us, the next 0 after this we got in a 22,000 level on election day. The next 0 which we got was on an election day on the 4th of June. Now this is the latest score. Now on the basis of this score, tell me whether the upside is limited or downside is limited. So the first alpha which I'm trying to tell you, or I'm trying to have a conviction in from your side, is it should come from when in equity, when in STP mode, when in debt mode, this primary area will cover the most of the part of the advisor's alpha. Now I want to you can unmute yourself and you can ask me.
Sir, I have a question. On what
Yes,
basis
yes,
this
sir, please.
parameter has been created?
So first of all, I want to ask this question: downside is limited or upside is limited? Downside
See,
is limited in the market or
downside is
upside is
limited.
limited in the market?
Yeah, downside is limited.
Are we in the 2007 kind of market? No, we
Yeah.
are far away from the 2007 kind of market. Okay, sir. Okay. No, yes. So of course, market can fall from here. But once zero come, again it will be a point of to sell everything and buy equity.
हाँ
But
दमन
still,
वाला
it
तो
is
कर लो
not a time to
फटाफट
go
यार
for STP. It is still a time to go for a
हाँ दिवाली का
without taking into consideration the risk profiling of investor. I am not taking into consideration what is the risk profile of investor here. I am just telling you to do the assessment on the basis of a risk profiling of asset class. After all, we will integrate both and we will look at the.
चलो देखना फिर लड़के का ना
Yes,
थोड़ा
sir.
मेरा
Yes, sir. Tell me any doubt?
Ashish, sir, I have a query.
Yes.
Hitesh here.
Yes.
In September 24, the latest number that you are showing is 0.69 for PE and 0.72 for price to book.
Yes.
And when I'm looking at your
So that was a
asset
daily score.
allocation,
That was for express book. That was a daily score. This is a monthly
no,
score.
I'm just trying to understand that the daily scores that you populate in your valuation cycle Excel, the last reading on 30th of September is showing as 0.8 for PE and 0.48
Yes, that is
for
for a
price
daily.
to book.
And this is for a monthly
So-
actually.
So basically, the monthly scores are derived as the average of 30 days score
Average of 30
of
days.
that
Yes,
particular
average
month.
of 20 working days.
Now, because the difference is huge in the sense that price to book is at 0.48 as the month end reading and the
actually, sir,
average
this
reading
file-
is
this file is
0.72.
actually
हाँ
not
बाकी
updated.
जगह बंद कर दे एक आध जगह कर ले कहीं पे बस
Hitesh, this
So-
file is not updated. This file is still 15th of September.
All right. Okay. So basically the closing score that we get on a daily basis is what
So
we need to
that
look
is
at.
actually more relevant. That is more. You are getting a view on a daily basis.
Okay, sir. Okay.
हाँ अभी तो गया तो देखो
Actually, I'm not navigating here on daily basis. Again, it will be a very time-consuming affair. So that's why I'm navigating here on a monthly
ठीक है
basis.
ना
So that too in September. So yes, so the question which has come
लड़का
from
अगर अच्छा रहेगा तो दे लेंगे 10-12 हज़ार रुपए
so if I look at the latest score here,
हाँ अच्छा हो
I
तो
don't know by
देंगे 12 है ना
what time this file has got updated, but let's look at the latest score here.
नहीं 10.5 अपन 10.5 से 6.5 टाइम
So the latest score for a P is 8.2 and PBV is 0.48.
ठीक और फिर उससे कॉलिंग वॉलिंग
Yes, sir. That's correct. That's correct.
Wasim bhai, can you please mute yourself? Wasim bhai, can you please mute yourself?
Wasim sir, kindly unmute yourself.
सॉरी सॉरी
So this is the latest score on a 0.82 is for a P and 0.48 for the price to book value.
Hi, Ashish, I have a question. Can I ask you?
Yes, sir. Please, go ahead.
Sir, the P before, like, I think there was a change in the P calculations by NSE in 2021. Sometime, before that, it used to be on a standalone basis, and then they came to the consolidated P. So have you taken that into consideration while doing these calculations?
No, sir. Definitely not.
Okay. Yeah, because on the consolidated basis, the P has got
All
compressed.
this calculation has changed 6 to 7 times in last 30 years. So it is not possible to incorporate that. And let me give you a very behavioral approach with respect to that. Everyone forget after a point of time. You will not remember that what has happened to do with respect to the calculation. So we have taken the data as it is what the NSE has provided us.
Okay. And you think the calculation P based on a consolidated is giving us the right picture of the P? Is it a realistic picture?
Whatever regime that has been changed, that regime change automatically is being captured from a score. Although it is not captured from the valuation, but it is being captured from the score. So that is the beauty.
Okay. So basically the formula has stayed the same before the change and after the change, it's the same
Right,
formula
right,
that you're
right.
applying, you know.
But score do incorporate that change. Score वो reflect हो जाता है.
Okay. All right. Thank you.
Thank you.
Sorry to ask this question once again.
Yes.
You have said the P ratio is more than 3, and when PB is 1.1 or something, you said you need to add one or more data which needs to be considered.
No,
Can
sir,
you
no,
please
sir,
just
no.
repeat?
Even if you are following only these two data, your decision making could be 90% improved. We are following 50 plus score in order to improve our decision by 99.9%. But if you are only following this, 90% of the decision can be taken on the basis of this. So let me take you towards 2021 is a very controversial moment actually. Let's go back to 2021. So in 2021, 4 and 0.98, 3.99,
Exactly.
4.92. From here, it is a movement where you have to be like cautious. Cautious means you should go for STP mode. Any other doubts, sir? And now actually this actually score 3 is very what we call this
Sure,
outlier figure.
sure.
This outlier figure has happened because it has happened very artificially for a let's say for a 6 month. EPS ही नहीं आया था sir market में. If EPS
Yeah,
is strong,
correct.
then artificially the P has got shooten up.
मेरा takeaway order होगा.
See, okay. See, we as a distributor, okay, when new client is onboarding at during that period, February 2021, you are saying to put STP, right? So if that
From
being
here
the case,
onwards, from May
yeah,
onwards.
how many
Let's say from May June.
months?
From May June.
Or else May or June? Okay, how many months? On what basis we should decide that?
And then the STP will run till here, till 0. Till May,
Okay,
June
say for example, if
2022.
somebody is bringing up 1 crore, okay, if somebody is bringing up at 1 crore, we do not know how many months STP we need to give,
Right,
right?
sir.
So
Right,
on
sir. So I think you are a new user. So, but for an old user, by default, the STP will go for a 2.5 year on a weekly mode. Whenever a score will indicate, you will stop the STP and will convert that STP into the equity, fully into equity.
Okay. Thank you.
Great, sir. Great. Sorry, I have skipped this particular thing for the new user. Thank you for highlighting this. So similarly, this is what the
Sorry, last question.
Yes.
Sorry. Say for example, if it is less than 8 months or 9 months, okay, if we need to switch it from one lump sum to other product or debt or some other category, now the short-term capital gains is about 20%. So how do you see that? Or else if you are going to cover that particular part of the near future,
I'm
then
coming to
probably I will
also
wait for
our
it.
algorithms being made for a two-setter advisor who want to enter also, who want to exit also. For the set of advisor who don't want to enter, who don't want to exit, what we call them, you don't exit, but stop putting fresh money into the unfavorable zone.
Okay.
So that you should not
Thank
have to pay a capital gain tax, but the
Okay.
investment journey could be much smoother if you avoid bringing money in the unfavorable zone. Don't exit,
Okay.
but avoid bringing the fresh money into that zone.
Okay.
Right.
Thank
So
you.
I'm coming to my now main particular this session. Now, this is the entire valuation cycle workbook. We have a 6 dashboard like this. First is the valuation cycle. So this is how valuation cycle dashboard look like. And study the valuation cycle at very core by taking into consider various input and calculate various kind of score. We have only seen a one score, but it calculates various kind of score. And on the basis of that score, so we have just got one sheet of this particular entire workbook. If you are interested, you can just go and you can navigate across any score of any worksheet. And once you click on that, it will take you towards that particular it will take you towards that worksheet. So before entering into that worksheet, do read the chapter, and after reading the description box, then click and enter into the worksheet. Now, if you don't want to do this, now the main question comes: where does all this supercomputer AI ML comes into the play? So actually, when I was trying to give you the inference from a single score, it was possible through a human eye to take out the inference, right? It was possible through a human eye to take out the inference. But if I gave you 50 plus score on a daily basis, it is not possible through a human eye to take out the inference. So that is where the AI and machine learning do the job. And it is beyond the human capability. this is where the supercomputers do work. So after taking into taking into the complete picture of entire input matrix and their score, there are many input matrix and score. It calculates the distilled scores. It calculates the distilled score. Now I'll come into this particular thing for the setup advisor. Now if we'll see that our distilled score varies from 4 to 8. How to read this distilled score? So once you click a cursor on any particular headline, suppose if I finish this particular workshop and if you forgot all the concept, you have to just put a cursor on a headline. Just put a cursor on a headline. It will explain you the same. It will narrate you the same what I am narrating you during the live Zoom session. So if you just put a cursor on a headline, it will tell you how to read that corresponding graphical visualization. And from yellow part and wherever the drop down icon is there, wherever the drop down icon is there, from a drop down icon, you can look at the score for, let's say, for September 2024 also, for a September 2014 also, for a September 2004 also. So we are transparently providing you the score, the inference, and the analytics. So whatever action we take totally on the basis of score and their analytics. It is never ever on the basis of curve optimization. It is never ever on the basis of a narrative or news. It is never ever on the basis of market level. We don't look at the news. We don't look at the narrative. We don't look at the market level. And from here, you can check according to a desired one and desired here what is the score. So here is the broader navigation part. From blue one, you will have a headline that will tell you how to read the corresponding graphical visualization. From yellow one, you can select the desired one and desired year in order to see the score. Now, how to read this particular score? So this is a distilled score. Now, again, I am coming back to the home page. So this is my first dashboard, which evaluates where are we standing in valuation cycle. So in data science, whatever we do, again, please mark this point. In data science, whatever we do, we totally do assessment on the basis of where are we standing. We totally do assessment on the basis of where are we standing. We don't look at the past data and what is going to happen in the future, no one knows. What is going to happen in the future, no one knows. And there is no relevance for the past data. So whatever decision we take in data science, from the lens of a data science, is totally on the basis of where are we standing. So if I look after the September score, so in summary, you'll have a distilled score. What is a distilled score? Distilled score is the unified score for an entire workbook. For an entire workbook, you will have a unified score at a summary. So each and every workbook, there are like 6 workbooks. For valuation cycle, there is different. For earning cycle, there is a different. For category selection, there is different. For sectoral, there is different. For style, there is different. All these dashboard is divided into 3 parts: summary, detailed working, yellow, underlying rational, green. In summary, you will have a unified score.
Yeah, one question here. Like how you taken the Nifty PE levels? Have you also taken sector-wise calls? Like, each sector, what is a
So we are coming into that, sir. I'm just covering this particular workbook. We will come into that. We'll come into that. Let me just first cover this particular thing. So the entire distilled score is being made from this particular valuation cycle workbook. Now what is the beauty of this particular workbook? So if you'll see, this is the barometer, and within the barometer, you'll see the mercury line that is in the form of blue color. Now, for the set of advisor who want to enter also, who want to exit also, for the set of advisor who want to enter also, who want to exit also, you will have a same score, 5.83 and 5.83. But here you see the different color. In yellow, they will keep neutral. From red zone, they will start getting out. In red zone, they will completely out. They will be completely out of the market. So for those score is same, 5.83, 5.3. But who want to enter also, want to exit also, they will follow the left-hand side score. Sorry, left-hand side, this particular barometer. For the set of advisors who just want to enter into yellow and green zone, but will never ever take out the money because of the, let's say, because of the capital gain tax issue, because of, let's say, they don't have execution capability to implement this across 1,000 investor, or let's say they say, Ashish, mere investor ka time horizon lamba hai. That means my investor time horizon is very long term. Why to exit from the market? So for them, They will only sit tight in the market. What will they will do in red kind of zone? They will never ever take out, they will never ever sit out of the market. But one thing what they will do, that they will never bring the fresh money in this particular red zone. So same score, but serving the both set of advisor. So similarly, if I look into the right hand side, this is the earning cycle score. So if you look at the earning cycle also for September 2024, still we are in green. For the set of advisors who want to enter also, exit also, you'll see it is in green. For the set of advisor who just want to enter but will never ever exit, for them also it is in green. Now, where does this business cycle score comes from? Earning cycle score comes from? It comes from a business cycle workbook. So valuation cycle scores come from a valuation cycle, earning cycle scores come from a business cycle workbook. So business cycle workbook will look something like this. So as I have told you earlier, that each and every workbook will be divided into 3 parts. For a direct guidance, go into the summary. For a detailed working, there is a orange part. For underlying rational, there is a green part. So each and everything is very transparently shown here. So we have, first of all, this is the one-stop platform in entire Pan India, which has collated data for a 20 plus matrix across 28 years. And then we have done a very exhaustive data processing work from where we have got the score. And after getting the score, we have deployed various kind of analytics. And after deploying the various kind of analytics, we are getting that. So each and everything is very transparently shown here. So there is no single platform in India where you get the entire important valuation matrix under a single place. You are getting the entire valuation matrix under here a single place. So we have collated that those data which are being are miscalculated in the industry, or let's say which are miscommunicated in the industry. The internal calculation we have done internally for input, and some of the data we have purchased from a outsource agency. So this is how business cycle workbook looks like, and the distilled score for a business cycle is here. So it is still in green. So in a business cycle, if you look at the matrix are totally different. There are 3-year earning growth, 5-year earning growth, ROE, corporate profit to GDP, credit growth, capacity utilization. All this reflect the business cycle actually, or an earning cycle. So here's the score. So still in market, without taking consideration the risk profile of an investor, still you can overweight into equity. Now the next question comes. Now Ashish, we have decided which asset class. Now the next question comes, which category and which subcategory, right? Which category and which subcategory. So for that, I will cover the third workbook. So we have seen the valuation cycle, business cycle. I will cover the third workbook, category selection, and then we will directly jump into the Alco master summary, and we will conclude today's session. In next session, we look after the marina and global market and sectoral. And in third session, we look after the Mulyankan GPT, where each and every expertise will be at your fingertip. You don't have to go and navigate different workbook. Just write a question in a Mulyankan GPT. It will enter into our entire dashboard. Will deploy all the kind of analytics, and then it will give you the answer, which will be very structured, very specific, and very human-like. So I'm going into category selection now. Any question till here, sir? Till here, any question which I've already covered? Any question till here? Now again, as I've told you, each and every dashboard will have a summary, detailed working, underlying rational. I'm going into the summary to make you explain how things look like. So here is now suppose if it tells you that you should not be in equity market, you should be in debt market. Or let's say you're bringing money specifically for the debt market. Now here also you'll get the score. From a headline, you'll able to read the corresponding graphical visualization. From a yellow and from a drop down, wherever drop down is there, you can select a desired year which you want to see. Now let's start with the debt market. Now the score for a debt market currently is 0.59 and the mercury line is ending somewhere in between the yellow. So irrespective of investor time horizon, I don't know about the investor time horizon now. If he's bringing money into the debt, if he wants to bring money into the debt, ideally you should place the category which should have a 2.5 year modified duration. Ideally, you should place the category which should have a 2.5 year modified duration. If I change the same September month to, let's say, September 2021, what is the score which is coming, sir? What is the score it is coming? What is the score it's coming here? It is ending in a red zone, right? It is a 1.20. So irrespective of investor time horizon in debt market, doesn't know the time horizon of an investor in debt market. It is telling you to go into the fund which have a modified duration less than 1 year. Now, if I remember the narrative of September 2021, all the manufacturers, all the media and magazines, or let's say the common narrative in the market was, for a US market, the narrative was that the 1% interest rate will go to the zero. And India narrative was, if you go to any bank, the bank manager was telling you at this particular time that do the 5% FD, or let's say do the 4%, 4.5% FD, because going forward, you're not even getting the 2.5% or let's say 3% FD. Going forward, you will not even get the 3% FD. But the score is exactly telling you the opposite. The score is exactly telling you the opposite. It is telling you to sit into the modified duration fund, which are less than 1 year. So in equity market, what is the risk? What is the risk of a 1.2 score? In equity market, the risk of a 1.2 score is that market can fall, or let's say the market can consolidate. So in equity market, the risk is of the falling market. In debt market, what is the risk? What is the key risk in the debt market? I want to ask to the user, what is the key risk in the debt market? What is the key risk in the debt market?
Default risk or duration risk?
So the key risk
Duration
in the market is the interest rate risk, right?
Duration, why
Right.
duration
Risk.
applied?
The key risk. So apart from taking into consideration the risk profile of an investor, that means the time horizon of an investor, you have to also consider what is the interest rate risk which is there in the market. So the interest rate risk here is highest in 1.2 score. Now let me give you a very real life example. In 1.2 score, you can take the risk in equity market. How? You can take the risk in equity market in 1.2 score? By increasing your time horizon, right? By increasing your time horizon, you can take risk in the equity market in 1.2 score also. Although the investment journey will not be smooth, but you will able to make the money. But in debt market, or let's say in debt category, you put your client's money with a two objective. That is a capital preservation and a protection. Capital preservation and a protection. So will you take the risk in 1.2 in a category where the main objective is preservation and protection? No, right? So irrespective of the narrative of the industry, and now whatever we are evaluating September 2022, it doesn't know that in 2023, sorry, in September 2021, it doesn't know that in 2022, the entire narrative is going to change. The entire industry will talk about the rising interest rate. So whatever is it evaluating, it is evaluating on the basis of September 2021. On September 2021, it is telling you that whatever money you are bringing into the lower than 1 year modified duration fund. But if you look at the narrative in the industry, it was all about corporate bond fund. In 2019, it was all about credit risk fund. Credit risk bubble got busted in 2020. All went into banking and PSU and corporate bond. When all money went into corporate and banking and PSU fund, the mark-to-market losses have started happening because of a rising interest rate scenario. Now, if you don't understand all this kind of stuff, if you don't want to understand the score, you don't want to understand the modified duration, or let's say the interest rate risk, If you go on the right hand side, it will directly tell you which category to go in. Just select the year and a month. It will directly tell you which category to go in. So suppose if I am selecting, let's say, June 2021, it is directly tell you in debt category, it should be in liquid fund. It is directly telling you. In debt category, it should be in liquid fund. So first of all, you have to decide from a valuation cycle, or let's say, we will come into the Alco master summary also. So first of all, you have to decide lump sum STP. If in lump sum, how much in equity? If in equity, how much in which category? That we will come into. If in debt, in which category of debt it should go into. So in this time, the debt category which it should go into was a liquid fund. So similarly, if I go into June rather than June, if I give it July, it is telling you to go into the banking and PSU debt fund in debt side. So that is how dynamically the score works and will help you to select the favorable category and to avoid the unfavorable category. Even if you are not readjusting the category, please avoid the unfavorable category. That is what I can least say you. Even if you are not, say, in a zero score, even if you are not going overweight into equity market, please at least avoid a BAF at that particular time. Because you are exactly acting opposite to the score. The probability of getting BAF delivering the higher return than the plain vanilla equity fund is like 0.1% probability only. So again, I am coming to my main point. It is all about at what environment, what category, and what asset class you select. And secondly, we will look into how to integrate the risk profile of an investor. That will soon come into in 10 minutes, in next 10 minutes. So here I have covered the debt also. Now the next question comes. If in equity market we have to overweight, or let's say if in equity market we have to underweight, which category to overweight and which category to underweight, right? Which category to overweight and which category to underweight. Now suppose in April 2023, it was telling you that the entire money should be in equity. Entire money should be in equity. Now the next question comes, in which category, right? So according to the data science, the world is very ideal. Now, please focus this particular point. Now, according to the data science, the world is very ideal. So it is very ideally telling you the calculation 52.5, 25, 22.5. Broadly, what you can assume, 50% should be in large cap, 50% should be in mid and small cap. Now, as we know, that this particular allocation can't be implemented for each and every investor, right? Now, this particular algorithm is being used by n number of advisor. Now, this particular advisor will use this for n number of investor. So, let's say there are 600 advisor, you're using this for 500 investor. So, you can't keep this ratio for each and every investor, right? Because whatever data science is telling you here, it is totally on the basis of a very ideal scenario, without taking into consideration the risk profile. But the key role of an advisor is to do a risk profile of an investor, right or wrong? Your key role is to do a risk profile of an investor. Now, ideally, 50% should be large cap, 50% mid and small cap. Now, how to read this particular score? This should be on the basis of practical implication. So we are providing you the ideal number also, and we are providing you the number which could be practically implemented also. We are providing you both. Now, what does this 50 and 50 score means? Now, this 50 and 50 score means, suppose, let's say if I am coming to you as an investor, and let's say I have a 15-year time horizon. So you are in a better position to judge my financial situation, right? So if you have judged my financial situation and my time horizon is, let's say, 15 years for any particular goal. So let's say you are advocating me 40% mid and small cap on the basis of my time horizon. Let's say you are advocating me 40% mid and small cap according to my time horizon. You have your own rule book, right? Everyone has their own rule book, that how much to advocate at what time horizon. So suppose at a 15-year time horizon, you are advocating me 40% in mid and small cap. Now, what does this 15-50 score is telling you? This 15-50 score is telling you, rather than going for a 40%, give Ashish 60%, the small and mid cap. That means increase that 40% allocation by 50%. Increase that 40% allocation by 50%. So the 40% का 50% क्या होता है? 50 कितना होता है? 20% होता है, right? So instead of giving me 40%, you will give me 60% small and mid cap. Let's say there is an investor which is coming to you. he has a time horizon of 8 years. And you are just advocating him 20% mid and small cap. So rather than 20% mid and small cap, advocate him 30% mid and small cap. So that is what this score is telling you ideally to implement. This is the ideal allocation which should happen. But this is the score which could be practically implemented for each and every investor. So for the set of investor to whom we are advocating 20% mid and small cap, make it 30% equity small cap. For the set of investor whom we are advocating 50% mid and small cap, because he is a very aggressive investor, advocate them 25% mid and small cap at this particular junction. When? April 2023. So first of all, you have to bring the money in equity market. What mode? Lump sum mode. Overweight or underweight into equity. Overweight into equity. Which category to overweight? Mid and small cap to overweight. If I change the same date to, let's say,
सर ये वाली शीट कहाँ से आई थी?
so sir, you will get this particular sheet in category selection.
जी.
In category selection workbook. When you open a workbook, वो कहीं से भी open हो सकती है, ठीक है? Workbook कहीं से भी open हो सकती है.
Okay, fine.
So just
Thank
click
you.
on a main menu or a home button. It will take you towards a main navigation panel and then go into the summary. So in summary, you will get all the major things in summary. So
Right,
here
sir,
is the
thank
score.
you.
Now this is the score. Now the score is -50 and -50. So ideally, it is telling you today also. It is telling you if you go back and if you still look at the broader score. So broader score is telling you to overweight into equity, to go for a lump sum mode. But now in which category? So 80% in large cap, 20% in mid and small cap. So this is the ideal allocation. But now you can't implement this ideal allocation to each and every investor. So here is the broader score. -50 and -50. That means for the set of investor who is very, very aggressive and we have kept 70% mid and small cap rather than 70% mid and small cap, bring that 70% mid and small cap into 35% mid and small cap. For the set of investor where you have kept 20% mid and small cap, rather than keeping 20% mid and small cap, bring that into 10% mid and small cap. And if you are not doing that particular trimming, what you have to do, the whole fresh money should go into the large cap. So if you are not readjusting the old money, please bring the fresh money into the large cap oriented fund. So either bring that into large cap oriented, or let's say if I put this in, let's say in September 2024, it is telling you to bring the money into the flexi cap kind of a fund. So this category selection, asset class selection, and the mode of investment is much, much more important than a fund selection. That is what we strongly believe. So this is how you can use this. Now we are coming to our last one. So we have covered 3 workbook. Now we are coming to the Algo Master Summary. Algo Master Summary is nothing but it's a summary of all the summary. It's a summary of all the summary. So here we will integrate the risk profiling of an investor with a risk profiling of a asset class and a category. So basically there are 4 profiles of an investor. Basically there are 4 profiles of an investor, and we have covered the entire 4 profiles. So in blue zone, you will get the entire summary of all the workbooks in blue zone. Let me cover now the taking into the integrated answer by taking into the risk profiling of a both asset class and a investor. So the first question comes for a investor who are like a low profile investor, who are like a low profile. First of all, we are covering the investor, which is a very common profile, which is like a no profile. No profile ka matlab kya hota? What is the meaning of a no profile? For the set of investor who don't have any fixed time goal, who don't have any fixed time horizon, or let's say who don't have any fixed financial goal, we say it a low profile investor. That means the investor only goal is to multiply the investment. He doesn't have any financial goal. He doesn't have any fixed time horizon. He can take out the money in 3 years also. He can take out the money in 5 years also. He don't have any fixed time horizon. He don't have any particular life goal. The only goal is multiplication of investment. So first of all, the question comes for this particular kind of investor is whether I should go for a lump sum, whether I should go for a STP, and when to convert that STP. So if you follow this just 4 times, I'm again coming back. In Algo Master Summary, if you go to the Algo Master Summary, it can open from anywhere. Okay? It can open from anywhere. Just click on home button, it will take you towards main panel. So I am just trying to make you learn only 4 tabs, this, and this. So for the set of investors who don't have any live goal, who don't have any fixed time horizon, and you want to take a broader allocation for him, and you want to take a broader allocation decision for him, just click on this particular thing. For September 2024, what is telling you? What it is telling you for this kind of investor? Whatever money he is bringing in, put half of the money in equity and run STP for the remaining amount. Now this STP will be for the, by default, if you ask the GPT, in GPT you will get this STP will for the 30 month on a weekly basis. When to convert that STP into equity? Whenever the score will get changed, it will inform you, the notification will come to you. Then it will inform you, the notification will come to you that this is the time to stop STP and convert the full amount into equity. So the investor who has like a low profile, the half of the money should go in equity and half of the money will go from a debt to the equity market in the form of STP. Now you can navigate according to your desired money, desired year. Let's say same September and same September 2021, what it was telling you. So in September 2021, it was telling you half equity and run the STP for the remaining amount. Suppose if I change same September to, let's say, April 2022. What is telling you? Whatever money is you are bringing for a no profile kind of investor. Actually, most of the investors are like no profile only. So whatever money you are bringing for the no profile kind of investor, run the STP for the whole amount. Run the STP for the whole amount. So the maximum alpha will be created for a mode of investment only. When to run for the STP, when to stop the STP, when to go for a lump sum. Now you doesn't know when to go for a lump sum, right? So I will see, like, just go, let's say, for a June 2022. See, in 2 months itself, it has told you to stop the whole STP and convert the STP into equity amount. Now the whole STP is into equity. So you can select it. Now, if you look after from June 2022, it has happened till date June 2024. It was for a no profile investor also, it was telling you to go only and only for equity. So for 2 years, there was no change in the advice. And the advice can change in 2 months also. So there is no fixed time horizon here. It totally depends upon the score. Now, what has happened in September 2024? It is telling you to run half money. So half money will be going to equity and half will be going to the debt, and from there you will run the STP. So the first question for a no profile is addressed here. Now 3 major profile are a lump sum profile, SWP profile, and SIP profile. So let's start from a lump sum profile. So let's start from a lump sum profile here. Now in lump sum also, there are 3 kinds of investors. One can be aggressive, one can be moderate, and one can be conservative, right? Now what it will do, it will integrate the risk profiling of asset class, it will integrate the input from your side, and it will give you the comprehensive answer. It will not only on the basis of risk profiling of investor, it will study the cycle also before giving an answer. Now let me select the aggressive investor here. Now again, in aggressive investor, you have a 3 choice to choose the aggressive investor. Means again in aggressive, you have a 3 choice to choose. First aggressive investor is actually very aggressive. He has done his investment in gold. He has done his investment in real estate. He has n number of cash flow. He's actually coming to your office to do an equity investment only. Means he want to sit into the equity market most of the time only during adverse market situation. Only during adverse market situation He's telling you to trim down the equity portion, that too not much, let's say by 20%. Only by 20%, you will trim down the equity portion because he's actually the aggressive investor and he wants to sit all in the market most of the time. So this is the, so again, you have a flexibility to choose. Within aggressive also, you have the flexibility to choose the sub profile of the aggressive. So this is the first aggressive investor. One minute, sir. Na? Sir, I'm in a Zoom session. I will call you back in 20 minutes. Yeah. So again, same aggressive profile. Within aggressive profile, you have selected all in. That means in 15-year journey, in its 15-year journey of this aggressive investor, you will get a trigger from this particular framework only 3 to 5 times. That means the readjustment will be done from your side in an entire journey of 15 years will be only 3 to